Good afternoon, everyone. I, Pragya, on behalf of NISM, welcome you all to today's webinar focused on one of the most sought after query, how to select a mutual fund scheme specifically within the realm of equity investments. As we navigate the complexities of financial markets, choosing the right mutual fund can significantly impact our investment journey's success. Mutual funds, particularly equity based ones, offer a gateway of diversified investment opportunities, allowing individuals to participate in the potential growth of stock market with the expertise of professional fund managers. However, within a multitude of options available, selecting the most suitable scheme can be a daunting task. In this session, we will delve into the fundamental principles and key considerations essential for making informed decisions while selecting an equity mutual fund scheme. From understanding risk profiles to evaluating historical performance and assessing expense ratios, we will explore the critical factors that can guide you towards choosing a scheme aligned with your financial goals and risk tolerance. Without further ado, let me take this opportunity to introduce the speaker of the webinar, Mr. Sanjeeva Mathur. Mr. Mathur is a seasoned finance professional having over 30 years of valuable experience of creating, promoting, and distributing financial products and services. He is a passionate speaker, especially on financial planning, and is engaged in spreading financial literacy across the country. In last 5 years, he has conducted more than 4,000 financial awareness sessions encompassing more than 2 lakh employees. Other than being a speaker at various forums, including Management Institute of Repute, he is also engaged as an external faculty for conducting sessions on varied topics on capital market with Securities Exchange and Exchange Board of India, Indian Economic Services, Indian Corporate Law Services, Indian Revenue Services, and other government and public services. He has been associated with FPSB India, Reliance Securities, Chola Asset Management Company. He holds a master degree in chemistry from Delhi University and is a management graduate from IIM Kozhikode. With these words, I welcome you, sir, and over to you.
Thank you so much, Pragya. Thank you so much for the rather long introduction. It was not required. Thank you so much. I hope I'm loud and clear.
Yes, sir.
Yeah, thank you so much. Thank you so much for the opportunity, and thanks everyone. Just 2 points before I start off. This is a webinar, and the biggest issue is webinar. Sometimes I face personally, there's a risk profile, is the network issue. Though I have 2 networks functioning at my place. So if I get disconnected on one, I will log off, but I will log back again. Request everybody to log down. I'll switch to my other. I'll do my another asset allocation. I'll be in some other network then. So just bear with me. Thanks, Pragya. I've spent more than 30 years before I get into the subject, which is of more concern. I've seen literally, not there are many people who are senior to me. I've literally seen this industry grow. I was speaking to somebody some time back before I opened the presentation. There used to be a time when there were 1 or 2 or 3 schemes, 5 or 6 mutual funds, 3 or 4 schemes, very easy to understand, very easy to decipher, very easy to invest, even the times when awareness was very, very little, hardly any anyway. I'm talking about 25, 30 years back. The fact sheet used to be 1 page, 2 page, 3 page, very easy, 1 equity scheme, 1 debt scheme, very simple. But times have changed now. Example is like buying a mobile phone, initially 1 or 2 mobile. Okay, this mobile is small, this is large with this camera. Now, if I give you 20,000 rupees, 25,000 rupees, 30,000 rupees, there's so many choices to buy a mobile phone also. So choices are becoming more and more difficult to select which one suits which one. So this is very important. So I just laid the base. I'll open the presentation. I'll divide the presentation into 2 parts. One is a very simple model, what you should look at while selecting equity scheme. Then we'll delve into slight technicalities also. Very simple, very basic. These are my personal views. You definitely might differ also. Just give me a second before I open the presentation. Yeah, I will go slow. I will go very slow, not to worry. So sorry. As the topic says, how to select an investment from different type of funds and schemes. As I said initially, just before I start off, it's just a research, which was done quite many years back by a person named by Hendrick. He said he studied 26,000 companies between the year 1926 and 2019. 15,000 companies destroyed 7 trillion wealth. That means there are many companies who destroyed wealth, but there were 11,000 companies which created 54 trillion worth of wealth for the investors. So wealth creators were 8 times the wealth destroyed. That means equity, if looked at from a different lens, is one of the best things to create wealth for you and me. Now, just everybody, if you don't know, I just have a slide, which is a very basic slide. Definitely, the structure of the mutual fund is given in front of you. We have an open-end, closed-end, interval, actively managed, passive, equity, debt, hybrid, solution-oriented, other schemes, etc. We're going to concentrate on equity. Like presently, when we speak right now, every day changes happen. Today, we are sitting on 45 asset management companies, 45 mutual funds which are there in India, 37 different categories of schemes, out of which 11 generally are of equity. Total number of schemes as on 30th of December 2023 stand at 1569. They keep increasing. The assets, average asset under management is the average. The mutual industry stood at almost 52 lakh crores. So we already crossed the 50 lakh barrier. So many schemes, so I can very well understand a normal person find extremely difficult because everybody says, my scheme is better than his scheme is better than mine. Very difficult to decipher which one to go for. Definition, so that you're very, very clear on this, because I'll be using these words as we proceed further. Large cap, definitely large cap, mid cap, small cap. There are 3 basically buckets with the equity market decided into. Large cap are the top 100 companies listed on the Bombay Stock Exchange according to market capitalization. Mid cap is 101 to 250, and below 250 are all the other companies. For the present, for people who don't understand this jargon, very simply putting it, a very rough estimate, just think that people are scoring the maximum number of runs in the top 100. Below that, between 100 and 250 in cricket, and below 250, the other cricket players. And they keep changing the position depending how many runs the person has made over a month or a quarter. The large cap, mid cap, small cap. This is how a general value system works. Types, before I get into equity, you have equity schemes, you have debt schemes, you have hybrid schemes, solution-oriented, and other schemes. Under equity schemes, where the first problem of understanding starts, okay? We have multi-cap, we have flexi-cap, large cap, you have entire list in front of you, we have mid, small, you have value or contra. You cannot have both. A mutual fund can only have either a value fund or a contra fund. You have a focus fund, sector thematic ELSS. Under example, multi-cap, there might be 40, 50, 45 mutual funds, 40 different kind of multi-cap schemes. 40 mutual funds, 40 different large cap schemes. So very, very difficult to understand. Sanjay, should I go for this one because this one gives me a better return? Sanjay, should I go for this one because this is promoted by a big promoter, a known bank or a known organization? Sanjay, should I go for this one because this is being run by a very well-known fund manager? Sanjay, should I go for this one because I feel this is the growing sector? What to choose is not so simple. Type of hybrid schemes, conservative, hybrid, dynamic, multi-asset allocation fund, arbitrage, equity savings fund, various other schemes are there. And on the other schemes, you have index fund, which copies an index, and fund of funds. Now, before we proceed further, we are not talking about debt today. We're talking about equity today. On the hierarchy of risk and return, higher the risk, higher the return. So there's nobody here who will tell me, Sanjeev, I want higher risk, but I don't want a return. Then many will tell me, Sanjeev, I don't want a risk, but I don't want a higher return. I want a higher return also. It doesn't function this way. It is not so perfect. So we labeled a few schemes here, which I'll go very, very slowly. We have an equity saving scheme, equity-oriented, large cap, diversified, mid cap, small cap, sectoral funds. These are basically schemes on the risk profile. As we move above the slope, the risk becomes higher. So returns expected from those schemes also become higher. But under sector fund, also there are many other sectors also. They can be a pharma fund, they can be IT specific. In fact, there are around 19 or 20 IT specific funds. There are around 30 banking specific funds. Which one to go for, which is the best for you, we just come to that. Always, for a very novice, for a very simple investor, when I discussed a fact sheet with you, this thing is very, very prominent. You know, people unfortunately, miss this thing and then say, Sanjeev, we have taken a wrong call. Whether you look at any poster, whether you look at any scheme, the first page of the brochure or the first page has this kind of a dial, has this kind of a speedometer, which is known as a riskometer. We call it the product labeling. It tells you basically the scheme which you're looking at, how risky it is, what are risk parameters. It basically is from low to very high. Very high was added just 1 year back. From very high is from low to moderate, moderate, high, very high. If you're investing in equity, obviously it will be on the slide on the higher side. So we're looking at whenever you first picture, whenever you look at a scheme, look at this graph. I'm just telling very fundamentally right now before getting into technicals. You have an equity scheme, the arrow points moderately high. So, okay, this has moderate arrow points high. This has high risk. Arrow points very high. This means this is very high. Can you take that risk? We'll come to that. Just to read out a few points, mutual fund are required to label their schemes on the following parameters. Nature of the scheme, I've indicated a time horizon. For how long can we invest? Generally, if I suggest equity, I'm not a distributor, but if I suggest equity, I would definitely say look at a 5-year plus horizon. Below 5 years, it can get slightly volatile. Okay, a brief about the investor objective. What is the objective of the investment? For the kind of product in which they investing, debt or equity. We're talking equity. A disclaimer which says investors should consult a financial advisor if they're not clear about the suitability of the product. Very crucial, very important. Riskometer is the first one which I think you should have a look at. Now, I'll expand because don't worry, this is slightly, don't have to read everything. Whenever the few points A, B, C, D were fund, which I will go one by one. Type of the scheme, what kind of scheme it is. Is a small cap, mid cap, large cap, flexi cap, etc. Be very clear about it. Because every scheme has a different objective. This is I'm yet not got into the selection part. You say somebody comes to, suppose you have a goal. Sanjeev, I have a goal for 7 years and I'm looking at, reasonable return, etc. Okay, I might say, sir, ma'am or sir, please go for a large cap scheme. We selected a large cap scheme. Read when you're selecting is what's the objective? Is it a large cap scheme? Read very clearly. Everything is mentioned on the form on the document. Measures investment performance on mutual scheme against a standard market index. Everybody has an index, has a benchmark. What are you marking your particular scheme against? It should not happen that there is like a very famous joke says I stood first in the class. There were only 2 students. Doesn't weigh that way. Okay, if it's a large cap scheme, what is the benchmark? Because I'm going to compare how I'm performing, outperforming when I get a little deeper according to the benchmark. The first riskometer, then look at these performance parameters. NAV, different NAVs are mentioned, whether direct or regular, direct or indirect. Secondly, whether you are going for the dividend part or you're going for the growth option, cumulative market value, measure first trading activity. Suppose when I get much deeper into it, the various aspects, suppose you're investing in a mutual fund scheme, who is the fund manager, what is the investment type you're looking at, what is the portfolio churning, etc. I will just come to one by one now. One second, please. 5 things to look at in a mutual fund fact sheet Why I have mentioned a fact sheet and the topic is discussing about equity scheme, because the fact sheet has everything what you want. It has the basic information. It has the performance aspects, the fund manager details, the portfolio aspects, and the key ratios, which will go one by one. Basic information. First thing, as I said, riskometer, which I discussed before, general information, the fund, what's the fund all about, etc. Objective or philosophy. Is it to generate return on a long term? With what kind of risk? It's very clearly mentioned. If you cannot take a risk, sorry, equity is not for you. If your horizon is 1, 2, 3 years, maybe equity scheme is not for you. This we're talking about 5-year plus. That's my view. Options, growth or dividend. Plans, direct or regular. Regular generally has a slight expense, higher expense ratio, but generally it goes to an advisor. Net asset value of each plan. What is the minimum investment amount? It's 5,000, 1,000, but it's mentioned very clearly. Systematic features, SIP, STP, SWP, etc. Assets under management. See, I'll stop here at asset under management. I was discussing someone a couple of days back, many years back. Asset under management used to play a very, very important role in choosing a particular equity scheme. I used to say, suppose there are two fund houses, two large cap schemes of different mutual funds. One has 100 crores AUM, the other has 1,000 crore AUM. The 1,000 crore AUM has 100 investors, the 100 crore also has 100 investors. Which one should I go for? The answer is, Sanjeev, 1,000 crores. No, I'd rather go for the 100 crores with 100 investors, because in case of a redemption, just imagine 100 investors, 1,000 crore fund, a redemption comes, the NAV might fall because the person who invested maybe a HNI, etc. More the retail, the better it is. So AUM used to matter a lot. But presently, I think so most of the mutual fund, which we look at in equity, have crossed that threshold limit of the AUM, have crossed the threshold limit of number of investors. So this thing doesn't hold, but it used to be a very, very important aspect. Previous discussed which scheme to go for. So, number of investors, less or more. Fund exit load. What is the exit load? How much I have to pay if I exit in 6 months, 1 year, 2 years? Matters. Product labeling, riskometer. What is this thing? Like this arrow, hypothetically, we mentioned that moderately high. That means what you're investing, you cannot take. Suppose there are two equity schemes. You have to choose between a large cap. Please, this may be a wrong correlation, but just for information sake, I'm telling you, you might be looking for a small cap scheme. You might be looking for a large cap scheme. And you cannot take much risk, but your horizon is 5 to 6 years. Large cap scheme might be, example, aiming at moderately high. Small cap scheme will be aiming at high. So obviously, in your scheme of things, you should look at moderately high. So this plays a very, very important aspect for a normal investor. Always look at this riskometer. Very, very important. I mentioned here also, just repeat 2 or 3. Low principal at low risk. Overnight fund, liquid fund. Moderate, principal at moderate risk. Income fund, conservative monthly income. Moderately high, principal at moderately high risk. Index fund, etc. High, principal at high risk. Sector fund, thematic fund. Obviously, if I put all my money in a sector fund, high risk, high return. That's why when I showed you that slide of debt and equity with that graph, sector fund were the highest risk, but high risk, high return. It depends on the risk profile, on investment horizon, and your goal, definitely. Performance aspect here. Everybody, you talk to a normal investor, Sanjeev, was last 1 year, last 3 months, last 6 months. This scheme has given me double-digit returns. I will go for it. I will go for it. Like it is not that way. Returns should, yes, returns are a very, very important aspect. Everybody who invests is looking for a return. The two things, remember, are you looking at goal achievement or are you looking at return? There are two different ways of thinking. Return is the most important aspect, but return at what cost? At what cost becomes important. Here, I'll put a little caution. People generally have a habit, even me, example, we used to have a habit, looking at 3 months, 1 month, 6 months, returns in equity. No. I think so when you look at equity, look at long term, look at 1 year, 2 years, 3 years, 5 years, and since inception, we will come to know that how volatile that particular scheme has been, what are the returns or the downside has been when the markets have not performed according to expectation or the markets have suffered a sudden downfall, example, when COVID happened, other market irregularity which takes place. Funds performance, lump sum as well as SIP is clearly mentioned in the fact sheet across time frame, compares it with other fund benchmark and a market benchmark. Fund managed experience qualification, very, very. Example, suppose I go for a tuition. Okay, when I was putting my daughter for tuition many years back, I will definitely go for a teacher who maybe who he or she has relevant experience and a qualification. Can he or she teach my daughter? Similarly, in returns also, similarly in schemes also, the fund manager experience matters a lot. Has he been able to manage, or when he was with some other mutual fund, how long has his time he spent there? What is his profile? What is his outlook? It matters a lot because ultimately the money which you are going to put in a particular scheme is going to be managed by a fund manager. Though we might say that the scheme objective is well defined, but still it depends on the fund manager how he generates return within those limitations. So these are things that are very important. Should always pay attention to the experience extent. And returns, I'll have a word of caution here. Please look at returns, not 1, 2, 3, 4 months. Mutual fund is not for trading, etc. It's a long-term thing, especially equity. So look at 1, 3, 5, beyond that. That will give you an idea whether the scheme which you selected is right or wrong. Portfolio aspects. Now, example I said, initially small cap, mid cap, large cap. I'm just telling, suppose there's a scheme, we are going to invest in a large cap scheme. Obviously, SEBI has well-defined parameters that you can't basically exceed. No fund manager can exceed more than a certain percentage of his investment in a particular sector, more importantly, in a particular stock also, or a particular share also. So what we do is portfolio. There are suppose 100. Suppose I'm going to invest in a large cap scheme. There are plethora. There are many large cap schemes which are available in the market, all saying I'm better, I'm better, I'm better, I'm better. Fact is, look at the portfolio. There are 100 shares. There are 100. The fund has to choose from 100 stocks. Generally, there are 50, 60 stocks in a particular. Which one is it? What is the outlook? I've just been an example. Whether if he's investing in a bank, does he feel the A bank will do better, or does he feel the B bank will do better, or the C bank? What percentage is he allocating that? Does he feel this IT stock will do well, which is the large cap, or the other one? How soon is he? Because everything mentioned fact sheet, we compare the fact sheets also. Does he know when to enter? Does he know when to exit? So these things are very, very important. I'm not naming any fund house right now. There was a kiosk which happened, which all of us have seen in a particular payment bank presently. Very, very important aspect. There are few mutual funds which had a high exposure. Why? Because it required. So if you can take the risk, very good. But it becomes a high risk call then. So these things are very, very important. Portfolio aspect. Asset allocation. Asset allocation means we understand where I'm putting the money, whether I'm putting in debt, whether I'm putting in equity or somewhere else. Exposure to different asset classes, equity, debt, cash in a portfolio. Company and sector allocation. Sector in IT, which one in IT? Bank, which one in bank? Cement infrastructure, which one infrastructure? What is the fund you're choosing? Have a look at these parameters. Otherwise, this is definitely, if you're going to get into a little bit of a detailing. Everything is mentioned. You can compare month on month. Fact sheet comes every month nowadays. Key ratios, where the confusion starts. I was just talking about some historical thing when I started off, except for portfolio turnover ratio, expense ratio, or maybe beta, nothing else was there in the fund in the fact sheet in those golden days. Now there's so many parameters discussed. People get confused. Hey, now this is the main part of selecting a scheme. You have portfolio turnover ratio, you have an expense ratio, you have the beta, you have the standard deviation, you have the Sharpe ratio, you have R squared, information ratio, tracking ratio. Sanjay, there's so many things mentioned in the fact sheet. How the hell will I understand? Just to simplify everyone, the I mentioned lower the better. Why? I'll come to that. Portfolio turnover ratio. In simple words, how many times I'm buying and selling? How many times I'm buying? Am I aggressive? See, two things. Understand now. One is the fund's particular scheme equity requirement is that you need not be aggressive. You can have a hold strategy, buy and hold. But the fund manager is aggressive. He buys and sells. Secondly, is the fund scheme requirement is buy and sell. Fund scheme requirement is that you buy and sell. Just for the formula sake, need not remember. Minimum stocks bought or sold, example 100 crores, upon the average AUM gives the portfolio turnover ratio. Generally 10 to 12% regarded as decent portfolio turnover ratio. Higher portfolio turnover ratio, that means higher transaction cost. You're buying and selling, buying and selling, buying and selling. It basically impacts the return. So suppose you have a large cap scheme. First thing, you have a large cap scheme. You looked at the portfolio. You are comparing 4 large cap schemes of 4 different mutual funds. Now, you selected that. Everybody's return is between 10 to 12%. 10 to 12% for the fund 3-5 years. You have a look at that. What is the PTR, portfolio turnover ratio? You said this guy is giving me 12% of the PTR, which is lower. That means he has a conviction of buy and hold. I will go for that. One of the parameters is PTR because it impacts, and that means in maintaining a low PTR, his selection is right. That's able to deliver a higher return. It's a perfect utopian situation. Doesn't happen this way. But the fact is, the first thing you can definitely look. So always mark the PTR. You generally find the PTR of small cap, mid caps, etc., can be slightly higher than large cap. So it might differ also. It might differ also. Lower PTR indicate buy and hold. Index fund, which basically replicates an index. What is an index? You buy that. So nothing is basically passive investment. Have a very, very low PTR. As I said, a smaller new fund tend to have high PTR. Like small, there are out of 4,000 small caps, which one to choose. So you keep buying and selling. Very, very important. Have a look at PTR always. Okay. Here I've compared large cap schemes. PTR growth investment fund is generally hard fund pursuing value investment strategy, because in value, you're generally picking up a stock which is undervalued. So that's why you're always a PTR will be lower on the value stock. Expense ratio. Very, very crucial, very important. Sanjeev, yeah, this fund is giving this particular scheme. See, we're talking about equity. First of all, whenever the comparison happens, selection happens. Because I have a financial planning side also. Selection on a particular scheme happens on the base. Suppose I have a goal 3, 4, 5 goals which are above 5 years. Then according to my risk profile, I choose a particular scheme, whether large cap, mid cap, small cap. Under that, which scheme suits me? Which one? This is that. Expense ratio plays a very, very important aspect. Higher the expense ratio, definitely my returns will get impacted. So first is Peter, look at a scheme which has a lower expense ratio and giving you a better return. Definitely, because their parameters well defined by SEBI, what the expense ratio, what you can charge, etc. I'm not going number by number, figure by figure here. It's self-explanatory, which I'll be sharing also, and it's very much available on every site also. Just to read out, obviously, liquid fund, index fund scheme, exchange traded funds, ETF shall not exceed 1% as SEBI directed. Closed peer will not exceed this thing. Over and above, expenses over and above TR, this total expense ratio. Few tax expenditure fund are allowed to charge over and above the total expense ratio limit. Brokerage commission, etc. are paid. Maximum 0.12%. This is just because it's there, I'm reading it out. Otherwise, need not pay so much attention. In case of cash market transaction, 0.05 in case of derivative transaction. Why I'm talking about TR? Because total expense ratio In a direct scheme, definitely is lower, expense is lower. In the regular, slightly higher. So for a similar scheme, for a similar time horizon, okay, the return in the direct scheme can be slightly higher because of lower expense ratio. But again, it depends whether you're going for professional advice or not. Totally depends on a person to person. Measures of risk. We've been hearing one word, beta. So we learned in fundamental, we learned the fund manager profile is very important. We learned the so-called the riskometer, which one to choose, total expense ratio. We learned about the PTR, portfolio turnover ratio. Now we're coming to more technical beta. We keep hearing this word beta. Yeah, beta of this scheme is 1.2. Beta of this is 0.3. This beta is 0.9. What does it signify? Why it is so important when you are choosing a particular scheme? Suppose you're a person who likes what is in the benchmark. You do not want to look very high return, etc., over the benchmark. That means one beta is 1. I want beta to be lower than 1 or maybe 1.01. We'll go for that kind of a scheme. Somebody can take more risk. I will come to that. Beta measures basically the relative risk, how risky the fund is compared to its benchmark. Benchmark, how risky am I? I also have to compare, I'm better than him or poorer than him. It depends. Beta, just for people who want to know, is a fund return minus a risk-free return. People who want to know generally, though it might differ. When we talk about risk-free return, we generally take the 10-year GSEC value. Somebody wants to understand that. Divide the benchmark return minus risk-free return. This is a formula. Maybe not remember this. Beta of less than 1 means that the security will be less volatile in the market. That means if something is going above by 10%, I will go below that. I'm less volatile than the market. My beta is less than 1. Above 1 means I'll be more volatile than the benchmark. It is that. Just to put it mathematically on the returns per se, I mentioned, suppose ABC multi-cap fund has a beta of 0.95. This implies if S&P Sensex falls by 1%, then ABC multi-cap is expected to fall by 0.9 because it is less volatile. Beta is 0.95. Similarly, if the beta was 0.6 or 0.65, the fund is less or more volatile compared to its benchmark. It depends. So understand, I'll again come. I talk about PTR, lower the PTR, better it is. Take it. Lower the expense, better it is. Secondly, suppose you're comparing a scheme, he's able to suppose there are 5 large cap schemes and the beta of 1 is 0.9, 0.95, 1, and he's able to outperform for a similar return with a beta is 1.1.2. That means the fund manager is able to generate the same returns or higher returns in the benchmark and compared to his or her other peer group also, despite keeping the volatility low. I will go for that. Again, understand one thing, standalone beta has no meaning. It's always for comparative purposes. Suppose I have 5 similar large cap schemes, okay, and everything rest taken, all giving similar returns. But one particular scheme, one large cap scheme, one particular mutual fund has a lower beta compared to the other ones taken is better. And high volatile times also, he or she will be able to maintain that. I will go for that scheme. Again, it might differ. One of the benchmarks is that. Now, standard deviation. These all are part of the fact sheet. You have BTRs, you have the AUM, you have the AUM, you have the riskometer, you have the portfolio, you have the returns. Then you have these things beta and you have the standard deviation. Standard deviation is nothing. How much I move around my mean in a very rough language. How much I move around my mean. How volatile I am around my mean. Suppose I invest in a particular stock. Okay, suppose I invest in a Colgate stock whose price is 1,000 rupees, just an example, or 100 rupees. Today, the stock is 90, tomorrow 110, day after 115, day after 150, 80. How, and I take the mean. of 1 year. And then I calculate the standard deviation, how much I'm basically varying from the mean. That's what it gives. Why it is important. The standard deviation of a stock or a mutual fund represents the riskiness of the stock or the mutuals. Remember, higher the standard deviation is pretty simple. Higher the standard deviation, more risky it can get. More risky it can get. That means he or she is highly volatile. It might suit somebody, it might not suit somebody. Higher the standard deviation, higher is the volatility. Higher the volatility, higher the risk. Generally, if I have to select a scheme, again, it's likes to likes. Please remember one thing, one mistake which a general investor does. I'm not talking about a seasoned player. I'm talking about a general investor. He or she starts comparing a small cap to a mid cap to a large cap, even a large cap direct to a large cap regular. No, compare apples to apples. If apple, Kashmiri apple to a Kashmiri apple, Shimla apple, Shimla apple. Comparison happens this way. Yes, which scheme you have selected, that depends on your goal and risk. If I, as I said, I'll repeat again, horizon 5 to 7 years, I might go for a large cap. Beyond that, a mid cap or small cap. Beyond that, maybe a sector scheme. It depends. Standard deviation plays a very important. So whenever you see, again, just an example, suppose I have 5 mid cap schemes, all giving similar returns, all having a similar PTR, all having a similar beta. Just an example, because beta is a function of standard deviation, all having a similar. But the standard deviation of one particular mid cap scheme is lower. That means that person is selecting stocks in his mid cap schemes which are slightly that means he's less volatile. That means he's not being so volatile compared to the benchmark. That's a very, very important. So I might go for that particular mid cap scheme of that particular fund house who has a lower standard deviation. Okay. Amongst the peer group, it's very, very crucial. That's why just an example of how it's calculated. So lower, the better. So this is, remember, lower the standard deviation, the better it is. Lower the standard deviation, the better it is. Beta, it's a function. If a higher risk, obviously will be higher, but it depends. PTR, lower, the better. So remember this particular thing. Whenever you look at a fact sheet or somewhere you are there, always look at this. Another thing which came couple of, one second. Tracking error. This you will definitely find many fact sheets, especially in index funds. Not is used for other schemes also. Now, this is basically when I have to compare how much I've outperformed the benchmark. Okay, example is basic difference. Tracking error is a difference in the return of the fund and the return of the benchmark index it tries to outperform or meet. Example, suppose I'm an index fund. You know, there are 10 index funds and the benchmark return of the index, per index is 10%, just hypothetical. Okay. And the fund manager is giving a return of 10. Very good. 10.1, very good. 9.9, okay. 9.8, oh, not a problem. Basically, the lower gap, other than that, the benchmark is not a good sign. Same or the higher gap, because if the fund is trying to outperform the index, it has to be higher. So it always says tracking error. Lower the tracking error, the better it is. Generally, we use a tracking error for index fund, generally. So very, very crucial. So whenever you're comparing index fund, look at the benchmark. Suppose you have 5 index funds and you have put everybody replicating a Nifty 50, just an example. So have a look at the tracking error, which is mentioned. The lower the tracking error, that scheme is for you. Because an index fund, that's the most crucial, most important aspect of selecting a index fund on the equity side. Nifty 50, just an example, can be any index fund for that matter on the equity side. Now, as we get deeper, now we very gradually covered the fund manager, the etc., the PTR, beta, standard deviation, etc. One very important thing, especially the the high net worths or very aggressive investors, they keep looking at one part, which is known as risk-adjusted return. What do you mean by that? Risk-adjusted returns. Okay. I'll just put a very simple thing because people don't understand Sharpe ratio. I'm going to take an example verbally. Just hear me out for 2 minutes. It's a very rough example, but I've been using examples for many, many years. Couple of years back, before why Sharpe ratio is so important and was most important thing by selecting a particular scheme. I take the example in every class or every session which I take. Many years back, when the Indian cricket team around 10 years back had, Virat Kohli, Rohit Sharma, all these cricket players were there. You had the 10 players and you had Dhoni also. This is around 8, 9 years back. Selection for the World Cup was happening. Before that, Dhoni's performance was not good. Virat Kohli was basically the captain and Ravi Shastri was the coach. People who understand cricket, please, I'm quoting cricket here, was the coach. So what used to happen is, his form was not very good. Means he was 35, 36. People are saying his past his peak, he should retire now. He was not doing very well. Still trying to score runs. Virat said, and there was another player who unfortunately got injured and recovering now. Rishabh Pant was knocking at the door. So people said, if let us take this guy in the cricket team, what's his name? Mahendra Singh Dhoni. Because Dhoni, even if he does 5 DRS, we have won the match. Even if he scores little run, we won the match. But if he fails, the entire onus will come on Ravi Shastri and Virat Kohli that he was not performing. Why did you take him? But if we take Rishabh Pant, which is a newcomer, even if he fails, nobody is going to ask us any question. But if he hits, he will be very successful. So basically, high-risk portfolio you having Mahendra Singh Dhoni at that time when he was not doing well. And you have Rishabh Pant, zero risk, but very good. Even doesn't fall, nobody is going to ask. So that extra risk, why you're taking back Dhoni in the team for the chance of winning is basically your Sharpe ratio, putting in a very rough and a very sporty manner. Coming back, Sharpe ratio compares the return of fund with its risk. A fund manager takes a call on his portfolio, adds a particular stock, etc., or the percentage increase to outperform. So that relative risk, that is what Sharpe ratio is fund return minus risk return upon standard fund. Higher the Sharpe ratio, better the scheme. That means the fund manager has taken the risk and is able to deliver a higher return. If he is not able to, doesn't matter. So therefore, Sharpe ratio, higher the Sharpe ratio, better return. Sharpe ratio considers only price-based risk and does not consider credit or interest rate risk. That's why Sharpe ratio is only used for equity scheme. Sharpe ratio is not used for comparison of debt scheme. Very important aspect. Suppose you have mid-cap schemes all across. Mid-cap scheme, everything similar, and Sharpe ratio of one particular mid-cap scheme is continuously higher than the others. That means the fund manager is able to deliver a return which is higher compared to the others by the unit risk which he's taking. I will go for that. So that's become very, very important to look at Sharpe ratio. We have mentioned a few examples also here. You can have a look. It's available in the market also. With low volatility or high volatility, we should always consider Sortino. Why I said Sortino? We'll come to this. Now, I talked about PTR, I talked about BTR, I talked about beta, I talked about many other factors, standard deviation, Sharpe ratio. There are two other ratios which are not part of a fact sheet, but as we evolve, they might become part of the fact sheet too, which I do not know. But very good for comparing particular schemes. If you really want to get deep into comparison, you are investors, you want to guide, you want to advise, these things, they are known as Sortino ratio and Penner ratio. Now, similar to Sharpe ratio, but measures the downside risk of an investment portfolio with high volatility. What happens is, Sharpe ratio, this is pure technical, Sharpe ratio generally takes standard deviation wholly. But let me tell you, Sortino, we're looking at negative side. See, understand people, a normal investor is more worried about his principal loss and downside risk than what returns he's going to make. That means he's not so worried. Well, okay, can we give me 12%? The principal is the same, but how much can I go down? So generally, a normal investor is more worried how much loss can happen. That's a general human behavior, human psychology. Sortino ratio basically, instead of capturing the standard deviation, it captures the negative side of it. It basically gives you that how many times I can go negative. It gives you a better view of understanding. So there's one more ratio, Sortino, other than Sharpe ratio, which captures the downside risk of the portfolio. Higher than one is considered to be risk-adjusted return. Again, higher the Sortino, the better it is. Just to mention it, I've mentioned example. Fund A is a better choice because Fund A generates more return for every unit of risk undertaken and has a greater chance of avoiding large losses. This is insight from the Sortino ratio. One more ratio has become very famous, very important for people to know. I always consider trainer ratio. We know Sharpe ratio, that's mentioned in the fund in the fact sheet. We generally don't see Sortino and trainer mentioned in the fact sheet. Maybe in time schedule it might be. Now, a Sortino has a limitation, etc. When it comes to diversified funds, to earn higher return, the fund manager takes higher risk, obviously. The beta of the fund represents that higher risk in terms of market volatility. Now you understand. Beta represents return of benchmark over risk-free return. This also you understand now. Tenor ratio is nothing. Fund return minus risk return upon beta. So instead of the standard deviation, which we calculate this, again, please need not get into much of technical since it's mentioned there. I'm repeating that. In Sharpe ratio, we consider the standard deviation. In Sortino, we consider negative standard deviation. In Trainer, which we consider the beta because it gives you a wider spectrum. It considers system and risk of fund that is not dependent on the diversity of the portfolio. Most student investors that are well diversified. So understand, suppose you are in a situation, 10 schemes you're comparing, which are well diversified. You're getting a similar sort, you're getting a similar Sharpe ratio. You can get into a trainer ratio. Higher the trainer, the better will be that scheme. So this is a very well diversified. You can have a look at these ones. I'll just delve again on a very fundamental. Look at the fact sheet, look at the risk meter. Does it suit your root profile? Look at the asset under management. Obviously, higher the better, but I say it doesn't matter much. The fund manager background, company background, yes, it matters. It gives you a comfort level, very comfort level. Fourth is look at the beta, look at the PTR, look at the standard deviation, look at the Sharpe ratio. Just to repeat, lower PTR, better it is. Lower expense, better it is. Lower standard deviation, better it is. Higher Sharpe ratio, higher Sortino ratio, higher tenor ratio, better it is. So these things are very, very fundamentally important to understand. So these are basically scheme. How I basically decide how we generally choose the schemes. Now, I could have put this pyramid, which many people of financial planners might have seen thousands of times initially, but no. Now what happens when I select the scheme, this thing becomes very, very important. What is my goal? What is my purpose for investment? Why I'm looking at a particular scheme? If my goal is 15 years, 20 years, that means I can take a high risk. That means high volatility, high will not matter. Definitely, I can go for a small cap scheme. It's just an example. Scheme selection starts from there. On the equity side, 5 years, 7 years, 10 years, 15 years. I just given an example. Scheme selection, risk profile, asset classes, asset allocation, strategic asset allocation as a result of risk profile, tactical, or market behavior, etc. Just coming to that. Very short term, if you're looking at very short term, less than 1 year, liquid mutual fund, please, just that we discuss the equity today. You're continuing funding, park your bonuses, windfall, etc. Short term is generally 1 to 3 years, debt mutual fund, vacations, car purchase, medium term, 3 to 6 years. Hybrid mutual fund, house purchase, car purchase. Long term, 6 to 10 years, diversified equity mutual fund scheme, children education, etc. Very long term, 10-year plus, diversified mid cap, small cap, sector funds, retirement, children future, wealth creation for next generation. Understand these are the generally 5 compartments which we decide for our investment into. We are talking equity. So generally equity starts from mid and long term, very long term. Then which scheme to choose depends on your risk profile. Remember one thing which I quote everywhere. We, all of us, or less than 1,000 of us, we can the same age, same income, same everything, but our risk profiling is different. So scheme selection can differ. For a 7-year goal, somebody, because of his or her profile, might go for a large cap. For somebody, it might be a small cap, mid cap. Under that mid cap, under that large cap, under that small cap, which one to choose depends on the parameter which I discussed, which are the ratios and the other fundamental attributes. Keep it simple. Always draw a paper, pencil, write down the goal, write down that, look at the time horizon, open the fact sheet, select a scheme. You get comparative studies everywhere now, right? It will be very, very simple to do it. That's it. Very important. Strategy allocation, tactical. I made the slide. It's very important for you to understand definition. Fixed target allocation for asset classes with periodic portfolio rebalancing. When I say rebalancing, equity, debt, equity, etc. Tactical. Target allocation for asset classes as per prevailing market conditions. Oh, market looks very volatile. Let me keep my money in debt. I will move into equity later. Let me move from small cap to mid cap, or small to large cap, or large cap to debt. That's different. Investment form, passive investment, active. Fund manager buys and sells. You try to outperform the basic benchmark. Passive, same. Type of need-based, view-based, goal-oriented, return-oriented. Buy and hold strategy, frequent trading, that means high PTR. Long-term, mid-term, or short-term, depending. Inflation, all these risks are there. Liquid risk, credit risk, interest risk, market risk. These are all fundamental attributes which your person should definitely consider while you're investing. Just give me a second, please. Investor behavior. We added the slide, very, very important while selecting a scheme. I talked about a lot of fundamental, a lot of technical, beta, alpha, etc., which we talk beta, sharp ratio, seizure ratio. Ultimately, people get carried away. That's why you say 90% people are basically are losing money because they're trading options, etc. So we keep hearing that. Okay, availability. Believe or believe mostly confirmation bias. I'm just telling you. Our beliefs, what we want to be true, really facts and evidence. Don't go by what you feel. Go by facts. Go by fact. Equity generates return over a long period of time. That's why don't look at very short term. Familiarity bias. Investor issue. Comfort. In familiar, known devil is better than unknown angel. Reality. Unfamiliar universe is far bigger and may have better opportunity. So equity has a better horizon. More people, longer term, they generate wealth. By and large, investors' money starts in their home country. This is the face of all. Okay? Herd mentality. Everybody's doing, I will also do that. It might not suit you. For group popular decision, investing in IPOs. I don't want to, because that's not my hobby. I don't want to say this thing. Loss aversion. Pain, which I talked about, Sortino ratio. Loss and pain from loss is more than pleasure from gain. We wait for share to come back to investment value before we sell. Right? Overconfidence, the biggest one. Tendency to overestimate our abilities. We think we have high chance of being correct. It doesn't happen this way. Recency bias, overemphasis on recent events, experiences and outcomes. Reality, past trends are not guaranteed future returns. Just an example. When COVID happened, unfortunately, I don't want to repeat that incident. What happened when the lockdown happened, the markets crashed to lowest level. Everybody was panicking. It will go to 6,000, 5,000. What happened? 8 months, it was to 18,000. Record after record, record after record. So please don't get absolutely emotional. Don't get carried away what happens. Follow the basics. That's a basic rule of scheme selection also. If you're selecting a scheme for a longer term, you have a 5-year, 7-year, 8-year horizon equity, definitely, then this 6 month, 1 year, 2 years, things happening should not bother you. Keep them out of the window. Comparing various schemes in each category. Data can be sourced from fact sheets. Data can be sourced from various money control. The umpteen number of sites which are available. Just give you one snapshot. Following parameters can be used for comparison. Investment style, growth, value, blend. Sectoral allocation, cyclical, defensive, sensitive. Historical returns. Please, historical returns are important, but they should not be the only parameter. Okay. Risk-adjusted return. I'm just summing up what I discussed some time back. Sharp, trainer, information ratio, etc. Size of the fund. which I talked about, AUM, portfolio turnover ratio, talked about lower the better, fund value, very important, very important. They're the parameters you should look at. Things will be simple. And most of things are available in a fact sheet of various sites, financial sites, which are available. I will discuss this thing. Generally, it is seen, let's skip this slide. I'll come to one very important, people say in the Sensex overvalue, before I sum up, etc. Sensex movements. Okay. Obviously, today also it was up, Nifty went up, etc. I don't think so. It depends. It depends. So we have, while selecting a scheme for 5-6 years, you have to be confident of the market. Very crucial, very important. Now, before I wind up, okay, sorry, so sorry. So sorry, I missed it. Just talk about one. I'm so sorry. 1 second. Just give me a second. I missed one slide. Just hold on. So what I discussed right now is 5 or 6 parameters where you select an equity scheme. It can be PTR, it can be your Sharpe ratios and other ratios, it can be beta, etc. And your goal orientation, whether it suits you or not. See, what I suggest everyone is then we look at fact sheets also, read papers, read the other parameters. You'll get knowledge. Knowledge is available on net, online, everything is available nowadays. Also, NSM as an institution, offers a lot of courses. Anybody who's interested, believe it or not, I do certain courses, just to enhance my knowledge. See, I just covered one minority expert in a rough code I do not know. The fact is, example, and it's often mutual fund, you have NSM 5A, which basically for the distribution, anybody interested in distribution, etc., should write. In fact, not write. There are a lot of books, etc., which NSM gives you. Go through it, you'll understand much better what I said right now, and other parameters also, not only equity. NSM 5B, anybody wants to understand just the basics, they should write the NSM 5B exam. Basically, I've written before, the examination seek to create a common minimum knowledge benchmark for all persons involved in selling and distribution mutual fund schemes. Very crucial, very important. Secondly, there are e-learning modules also. By professionals, e-learning modules. This course will help you to understand the basic starter journey to know how to invest in mutual fund, explain the jargon along with the benefits and limitation of investing in mutual fund. What I discussed right now in a much elaborate, in a much better manner, definitely. Course content, types of mutual fund, risk factors, all the parameters available in the e-module. Anybody who's interested, I personally believe you should subscribe and you should do it. Key features, it's a 4-hour instructor-led pre-recorded session. Course assessed for 30 days from the date of registration. 100% online self-paced learning e-course. Study upon successful completion. And the cost is also written here. So just to sum up, it's not a rocket science. First, select the scheme. Select a goal, 5 year plus, 7, 8 years. Select the scheme which is commensurate with your goal and risk profile. In that scheme, there are various mutual funds. Parameters, again, just before I wind up, low PTR, low expense ratio, low standard deviation, high Sharpe ratio. That's a perfect fit. Obviously, high Sharpe, higher Sortino, higher Treno. Why necessarily higher Sortino Treno? Because they're not mentioned in the fact sheet as of now. They simply enough, and you can start in that. Returns matter, but return with these parameters, giving a better return will always be better to select the scheme. I think so. I don't want to add anything more. Kuldeep, if you're there or anybody who's there, okay, that's what I had to speak about. If I missed out something, definitely you can add up. No problems. Pragya, you're there?
Hello, sir.
If I missed out something, please let me know. I'll add it.
No, sir, the session was wonderful.
Just give me a second. I'm not able to hear you.
Now, am I audible, sir?
Yeah, now you're.
Actually, I think we have received few queries from
Yeah, sure. I'll open them.
Participants.
Yeah. Yeah. Can one MF scheme have more than one scheme? No, they cannot do that. They cannot that. No. I'll go one by one. Can I go one by one, Pragya?
Sir. Yes, sir.
Obviously, recording, definitely, I think so. That's upon NSM. They can give it to you if they feel appropriate. It's upon them. Yeah. See, how will you come to know how many investors are there? Is yes, definitely. You can call up somebody's asked me that. definitely can call up the mutual fund. They will tell you how many investors they cannot hide. They will let you know which particular scheme has how many investors. They will let you know. Okay, they will let you know. That's not a problem. Yeah, PPT will be shared. Not a problem. That's been the NSM. Benchmark. How is benchmark decided? See, basically, generally for a particular scheme. Golak, somebody's asked me, how is the benchmark decided? Is it same for similar funds from different fund houses? Let's have similar schemes. Generally, there are 2 or 3 benchmarks. And for example, for a large cap scheme, you have a particular benchmark, which is common across the mutual fund. They can add 1 or 2 more benchmarks. Definitely, they can be 2 or 3 benchmarks also for that particular scheme. But generally, the category which will be large cap, mid cap, small cap, generally have the same benchmark. They select the benchmark, which is by CRISIL or by ICRA, etc., which basically have the same parameters according to which scheme you're going to define. Yes, most of the scheme of a similar category have a similar kind of benchmark. Same one, they can be 1 or 2 benchmarks also for that scheme. Clear? I'll go ahead. Yes, Rajiv, you can definitely call the mutual fund. They will let you know. They will let you know. They have to let you. Okay. Tracking error, I've already said. Tracking, I've already explained you. Is basically there's a benchmark, okay, and how much plus minus you're above or below the benchmark. It's basically standard difference, standard deviation of the benchmark and your actual return. Lower the smaller, the lesser the tracking error, the better, because that means you're able to replicate the benchmark. Naresh, yes, it depends on your. You've asked a very valid question, which happens in most of the cases. Some fund of high PTR have generated high returns. Yes, if your risk profile, I'll answer in a very investment manner. If your risk profile allows you to take that risk, high PTR, high return consistently, it's not a problem. It's not a problem. I can go for that scheme. Not an issue. It can happen. But and if you can take the volatility, and you can definitely take that risk also. If it happens the other way around, there's no problem. It depends on a person to person. If a person cannot take too much of risk, he should avoid. If he or she is willing to take, there's no problem. Fund is giving higher PTR and constantly high returns, it's not an issue. Naresh, I hope it's okay if Naresh is listening. Chirayu, it is I'm not saying high PTR is wrong. Okay, please. I said generally it is better to have a lower PTR. If some of the other I'm able to generate a high return with a lower PTR, okay, I'll be happy. They can be, again, I said, which I answered Naresh sometime back, a higher PTR will always, be open to higher expenses because it basically impacts return. But again, if the fund manager consistently is able to give a decent risk, okay. But all depends on your risk profile. Personally, for a normal investor, I will avoid. Vinod, are there many questions coming? The 95, 96. Pragya, there's so many questions coming. I don't know how I'm able to take everything. Okay, but I'll answer a couple of them. Okay, this is an interesting one. Thank you for this information. Can these parameters, Vinod has asked me, exit strategy. See, exit strategy depends on you. There was a very, statement which I made. You're investing, whether you're investing for a goal or you're investing for a return. Whichever happens first, exit. Okay. If it is not happening, you need to allocate. Okay. What happens is generally, it happens in equity markets a lot. Sanjeev, okay, I made 10% today. It will go to 110. I'll make 20%. It falls down. If you achieve the required goal, exit. It can happen earlier. It can happen slightly later also, depending on the market conditions. You should exit. You should have a return in your mind, which is not very aggressive. You should commensurate with the fund, with the scheme, and with the goal you have planted that scheme for. That's very, very important. That's how generally you plan your exit. If you feel the markets are not doing well and it's not for me, you had a goal for 5 years, 7 years, nothing has happened. On the fourth, you also come to know that nothing, you're not going anywhere. You should exit and get into some other scheme or some other asset class. That's a journey plan. It should be very clear whether you're looking for a return or whether you're looking for goal. Return can happen period of time. Goal is time bound. Return can be time bound, or return can be not time bound also. It depends. Vinod, I hope diplomatically, but I've answered you. It is that way. One question I'll answer. Two questions I'll answer, then what do you call? See, where standard deviation is the square root. Variance is the calculation. How much I varied from the mean. When you calculate the variance. Okay, how much you're varying from the mean. Standard deviation is square root, nothing else. Okay, so don't have to worry on these are mathematical formulas. How's ETF different from a normal mutual? Mutual fund is NAV based. You can buy and sell only once in a day. ETF is like a stock. First of all, in mutual fund, you don't require a demat account. ETF, you need a demat account. In ETF, you buy and sell a particular scheme, a particular ETF on real-time basis between 9:15 and 3:30 in the market hours. You buy and sell, you can buy the same day, sell the same day. In the mutual fund, you cannot do the same. Okay. Basically, you can trade in an ETF, you cannot trade in a mutual fund. So mutual fund is basically NAV based, which is published only once in a day, the next day. ETF is like a share price which keeps changing every second, and the ETF invest that will be 9 to 3:30. I need a demat account for ETF, and you don't need a demat account for a mutual investment. That's the basic difference. First of all, Deep, start reading books, and you need to write the 5A. Right? If you are listening, Deep Patel, who asked me, an MBA student, the best thing is write the NSM 5A examination. That will give you the entire thing. The first stepping stone is that. Write that, get a feel of it, then enter. Okay. NSM 5 is the right thing. You're still in the study mode. You'll easily be able to clear it. It's not a problem. Okay. So it's mentioned a fact sheet or the P or definite fund, what do you call, the scheme can give it to you. It can be mentioned also. There are many sites which give you this P of the fund. It's not a problem. It's very much available. Or if you call it the fund house, they will also let you know, ma'am, Matri Shah. 5B is for generally for beginners, Prakash. One query I'll answer lastly, which is mentioned, if we take 1-3 year for any equity scheme, why there is a dip in, see, I'll tell you. Suppose Narendra Singh Shekhawat, I'll just answer this question. If a customer stay invested for longer time in the market, then why the return dip as compared to 3 years? Mathematical answer. Okay, mathematical. Okay. Obviously, suppose I drive my car. I drive my car. People told me my car is going to give me 15 kilometers a liter on the highway. Okay. Now I stay in Mumbai. The entire roads are not highway. Okay, and highway gives me 30, not more than that. On the highway, if I drive for my entire life on the highway, it will go to 14 also. Or it will go to 14 or 5 years I'm driving continuously. But it doesn't happen this way. Okay. Generally, there are roadblocks. When I drive in the city, it doesn't even give me 8. So average comes to 9. Okay. So there are roadblocks. So in 1, 3, 5 years, generally, there can be periods where there were roadblocks in the market. Like what happened during COVID. Returns fell. They went negative for 1 year, average returns. That's why 1, 3, 5 years will find an anomaly. That's generally longer term return are averaging it out over those number of years. Virendra, I hope I've answered you this question. Okay, so very, very clear. You have to look at average return over a period of time. You cannot look at that 1 year spike. Oh, 1 year spike of 50% return. But how many people invested at that time? That's the whole question. Okay, the people are not there. Understand this thing very clearly. It's for a longer period, things average out. That's the whole idea. Aditya, it depends on you. ETF better than MF? No, it depends on your goal, on what your risk profiles are, what your return investments, what you're looking at. There's no comparison. They're two different parameters, different way of investments, totally upon you, what you want to invest. I missed many questions. There are many sites, go to mutual fund, go to grow. It's many sites you can look at here. Underperformance Bhavik, unless and until I'll answer my last question. How many years of underperformance is acceptable, or should we wait? 1 year, 2 years, unless until some market anomaly like COVID happens, 1 year is okay. Beyond that, no. In equity, you should not look beyond 1 or 2 years. If underperformance is there for more than 2 years, shift out. Shift out. They're very candid. No, those because locked in this, very, very clear. More than 2 years underperformance, move out. Move out immediately. All right, I think so. I'll not be able to take up every question. Pragya, you there?
Yes, sir. The questions will keep pouring up.
Pouring.
Thank you
What
very
you can
much.
do, Pragya, you can, since you'll be having the question, any specific question which you have, send across to me. I'll answer them and send it across to you. Okay.
Sure, sir. Okay.
Yeah, because
Thank
otherwise,
you very much. Thank you very much, Sanjeev sir, for this very informative session. I hope most of the queries of the participants are addressed now. I also thank all the participants for attending this webinar. Thank you. Thank you all.
Thank you. Thank you. Pleasure is mine. Thank you so much, Mashka. Thank you. Take care, Mr. Black. Thanks so much.